Let's talk a little bit about bonds. We were just kind of hitting on the yield when it comes to the 3-month, the 1-month yield even higher than that. So short-term bonds really in vogue right now because of that yield. Give us a sense, when you're telling your clients to allocate to bonds, what's the percentage right now today? How does that differ from a year ago?
So the typical client today, it has crept up. Historically, we've talked about the 60-40 portfolio, but over the last decade, it's been extremely difficult to get the kind of yield that we needed from that 40%. So there was more allocations to real estate and those sorts of things in order to get that yield that we needed from the 40%. But because of what's happened in the last 12, 15 months, we've been able to go back, if you will, to a decade ago, decade plus, and begin to do some allocation. It's incredibly attractive to people with all the volatility that's going on to say, hey, listen, I can get 5% and it's really safe. A lot of people are interested in taking that option.
Okay, so it was 40%, let's say a year ago. What is it now when it comes to bonds?
More like 45%.
And is that all short-term bonds that increase, or are you kind of
It's
spread it
not.
out?
It's not all short term. It is spread out some, although we're placing significant emphasis on shorter durations. Things have been ticking up. Perhaps we're done with rate hikes. Don't know for certain.
Right.
With the possibility of a recession in the offing, who knows if we'll be looking at rate cuts, somewhere in the next 12 months.
Okay, here's something else you're looking at. This is pretty interesting. They're called buffered ETFs. So these are
Yep.
ETFs with downside protection, but they also generally have a capped upside. In this environment, why should investors take a closer look at these?
Well, so some of our clients are saying, hey, listen, we really can't afford to be out of the market, but I'm incredibly nervous. And, we go through the process and explain, hey, listen, here's an option for you so that, we believe fundamentally that at the end of the day, Congress will get its act together and we'll get a deal. But what if we don't? What if things go down further than we expect them to? Well, here you've cut off a lot of your downside as far as equity markets are concerned, but you still give yourself the opportunity for a significant amount of the upside. So it's one of those things that's very appealing to people that are nervous and closer to retirement or in retirement.
Yeah, it's a really interesting idea. I think all of us want maximum upside, and if you can have a limited downside, that's good, but still capped upside. So I got to think about those for a minute, Lee.
Absolutely.
One other thing we want to talk to you about is portfolio protection. Is there a move that you're telling your clients to make, outside of going into short-term bonds to protect their portfolio with all the volatility and all the questions?
Yeah, so one of the things that we've been doing with some clients is saying, hey, listen, there are some things that might be a little more liable to the downside if things play out the way we think they do. One of the things that I believe, and, I'm not by myself here, is that we're either in a recession or we're headed that way, albeit I think it pretty mild. So there's companies like Exxon, which I love and I think it's a great company. But if in fact we do roll over into a recession, I expect Exxon to come off of its highs. We're up at 115 bucks a share, off of $35 a share at the beginning of the pandemic. Let's trim some of that. Let's take some of our winnings off the table and other stocks that might be a little more susceptible in the event that a recession does materialize.